Hey guys, this is Toby Mathis, and you are listening to Tax Tuesday. I will be joined momentarily by Jeff Webb as well. Fortunately, he just managed to have his computer go toes up literally just about a minute ago, so we're going to let him fix that. In the meantime, I'll certainly just keep on jamming on. I'm going to move my question box a little bit to make it easier to read all the questions. You guys have a lot of questions already today, which is really cool. Thank you. And I'm going to move these down. All right. So first off, it's always bringing tax knowledge to the masses. I'm going to give you an idea where I am right now. That's out my window as I'm speaking. I closed the door so you didn't have to hear the wind. I'm in Maui teaching a continuing education class to about 130 really cool realtors out. They all come in from Anchorage every other year to do their continuing education. Really neat group. Only group that I work with that at 8 a.m. they actually have a full bar. So that's Alaska for you. Cool people. Anyway, as always, you can get lots of information, free information on YouTube and Facebook. Feel free to join us, andersonadvisors.com, andersonadvisors.com, /YouTube, /Facebook will get you there. You can always also do our podcast, which is /podcast, or go to, I'll show you where you can sign up both with Apple Play and or iTunes and Google Play, where you can actually go in and listen to all the Tax Tuesdays as well. Somebody says, do you provide legal CLEs? Yeah, Dimitri, we do quite often. The way it works is a lot of our classes are either pre-approved or you just submit the information. So you can actually do that. There's a lot of questions already coming in. So there's a few from a couple. Hey, Mark, we're over, I'm just sitting over here in Kaanapali, which is a really cool place. I'm sure you were familiar. I'm sitting at the Black Rock, so they always do it at the Sheraton here. All right, so going back to the CLEs, you could always hit us up, and we have folks that work on the continuing education side. A lot of our courses are continuing education for accountants, et cetera. I'm not sure exactly how it would work for continuing education on the Tax Tuesday. A lot of our courses obviously are already qualified, but the Tax Tuesdays, I'm not sure how that would work. But you can always check it out. Somebody said, was told $500 was a limit for charitable donations of goods, not cash, for the year in total. Another said that it was just per charity. Can you clarify a limit? Sharon, it's not quite like that. What happens is if you're 500, whenever you're doing cash, it's never an issue about providing backup. Whenever you're providing goods, then you have question as to whether you have to provide an appraisal. And if you're under 500, I think you can just do an estimate. I think if you're going over that amount, you're going to actually have to break down the items and get fair market values on each item. And it's not per charity, it's for the taxpayer when you're giving goods. So I hope that helps. All right, so let's jump into this. I have a lot of questions to go through. As always in Tax Tuesday, if you ask your questions, I try to get to everything before the end of the webinar. Sometimes they're coming in too fast, and sometimes they're coming in. Somebody will get to you on the for over a $5,000 evaluation, you have the appraisal. There's something else between the 500 and the 1,000 too, I believe, but I'd have to look that up. Maybe Ricardo, you can do that since I see you're on the call. If you want to send in questions to Tax Tuesday at Anderson Advisors, you can do that, and we answer those questions. I think I hear somebody on the line. Is that Jeff?
Yes, it is.
All right, so you're back. So you killed your computer. You can always pick up a phone and dial in too if you ever need to, buddy.
Well, the whole computer froze up, so.
That's usually a minute right before we were just chatting, and all of a sudden you just fell off. So I was like, oh, probably Microsoft, right? Hey, if you need a detailed response, just send it into Tax Tuesday. If you're a Platinum or a tax client, we answer those. If you're not, then we tell you how to become one. If it's just a general question, we take out of that pool, we grab a bunch of questions, and so that's what we're going to be going over. Dimitri, where can I find out information on the CLE courses? Just somebody should reach out to you. Maybe Susan, you could do that. Just grab Dimitri's information or give him a And I think it's Valerie that handles that in our offices, so you can try to get continuing education. All right, opening questions, and I got a ton of them, and I'm gonna have to minimize a lot of the little things that are on my screen, so I apologize if you hear a little delay. It's just because I'm on one screen today. I've received a large sum of money via inheritance in 2019. How can this amount be protected and have its tax burden minimized? Answer that. I am married and want to start my real estate business. My husband is not interested in any of these businesses. How should I proceed without interference from my husband for both tax purposes and legal protection? As that's a can of worms right there. I live in Illinois and am planning on starting a real estate business. I heard LLCs in Nevada, Wyoming, and Delaware are good. If I create an Illinois LLC, should I also have any of the other three, or should I just create a Wyoming LLC and not Illinois? We'll go through all the options on that one. Move this thing. There we go. How do you fill out the personal reimbursement for an LLC Form 1065 partnership and transfer it into a C-Corp Form 1120? Interesting question. We'll answer that. If cashing out for long-term stock market gains, how many days after cashing out can funds be redeployed in opportunity zones? Certainly go over that. The current limit on home mortgage interest deductions is a max of $750,000 for loans after 2017. Does that mean if you have a loan for $1 million, that 75% of the interest is deductible, or that none of it is deductible? We'll go over that. I have paid $50,000 in legal retainer in the litigation case in 2017. The fees were withdrawn throughout the year in 2018. There is still credit on the account as not the entire $50,000 was used yet. How can I deduct the legal fees? We'll go through that. Is keeping a log of miles always required? So there's a little typo there. How should the car be purchased so all the miles are considered business? We'll go over some of your options there. I sold an investment property in 2018 that I had owned for more than 20 years. What is the tax liability on the sale of an investment property? What are the options for mitigating the tax liability? I have an LLC taxed as a C-Corp that manages my rental properties. It will not pay any wages and will operate at a loss for the next several years. It will provide fringe benefits. Can this entity sponsor a self-directed 401k plan to accept rollover contributions? Great question. We'll go over that. What is your opinion on cost segregation software which can allow CPAs to prepare cost segregation studies for $400? Is there any disadvantage for this versus physically sending someone to the property to do the cost seg? I would love to answer that one. Yes, that'll be a great question. If I make a large stock contribution to my 501c3, are there any capital allocations or income sourcing requirements that would force my charity to sell it off? The loss from one pass-through rental LLC exceeds the gain from another. The LLCs are in different states. Do I pay state income tax with the profitable LLC even though I have a federal loss? So we'll go over that. That's going to be great at that. If you buy a house as an investment property, hold it for 5 years, take depreciation for 5 years, sell it and do a 1031 exchange, what happens? So you have to pay the depreciation back when you do the 1031 exchange. That's an interesting question. We'll answer that. I'm initiating the sale of a California rental property that was held in my personal name. I will initiate a 1031 exchange, but would like to put it in an LLC for asset protection and tie it to our management C-Corp to pay expenses. Can I do this? So yeah, we'll go over that. There's some those are really good questions, by the way. Like, this is a good grouping. Is a quitclaim deed sufficient to transfer the title of a timeshare from personal name to a revocable living trust in California? We'll answer that. If you have a HELOC on your personal residence, which is in your personal name, and you use the HELOC, that's a home equity line of credit, by the way, to buy and renovate homes for your business, can you still deduct the HELOC interest as a business expense? And then I am closing on a condo under my name, but I would like to have it under my LLC as I'll rent it out. The problem is the rates are a lot higher for the commercial loan to an LLC, so I was thinking of getting the mortgage under my name and then transfer the title to the LLC after the closing. Is this a problem? We'll answer that. I have a holding LLC and subsidiary LLC with rental property in it. I need to put some expenses on a company credit card. Can I use a credit card for the holding LLC and have the subsidiary LLC checking account pay the credit card bill, or do I need separate credit card for each LLC? Fantastic. We have a lot of questions. Jeff, who does that? Who picks all these questions? Gosh, bless it.
I don't know, but he must be one great guy.
So that's my sorry butt that does that to us every time. Hey, we're going to get into we have a lot of questions, but I'm just going to bust through some of these. Did you want to knock out this first one?
Yeah, I received a large sum of money via inheritance in 2019. How can this amount be protected and have the tax burden minimized? This is a common misconception. Inheritances are not taxable to the recipient. And they probably aren't taxable to the grantor, the person who's giving the money, unless it's a substantial amount that's being inherited, like over $11 million. So this is money. Anytime you receive money or anything else in inheritance, it is yours. If your grandparents bought a house for $50,000 30 years ago and it's now worth $400,000, $500,000, that house is worth $500,000 to you. So the inheritance almost always works out in the recipient's favor.
Mm-hmm. Another big one is when you inherit property, there's a step up in basis when somebody passes. So there's actually no tax liability. So if I had, let's just say that I owned stock and I inherited it from a parent, and they bought it for $1,000 and it's now worth $100,000 when they passed. Your new basis is $100,000, and that goes for real estate or anything that appreciates. So when you inherit these things, not only is there a huge exception, it's over, like Jeff said, over $11 million. I think it's $11,400,000 this year per spouse. So married couple, if you do that right, is going to be $22.8 million. But you will not have to worry about tax on that when it comes back.
And the stock is a good example because I could inherit it today and sell it tomorrow and pay almost no tax on capital gains because my basis would be pretty close to matching what I'm selling it for.
Yeah. So, and then if you want to protect it, you protect it just like you would anything else. You'd literally put it into an LLC is probably going to be the best thing for you, depending on what type of asset it is. But if it's just cash, you're just going to want to make sure it's separate. It's not in your personal name. So the way that I would be doing that, if I inherited, a couple $1 million in cash, $3 million, whatever it is I'd more than likely have that put into an LLC separate from me, just because there's no way to minimize things that I do or things that my kids do or things that could cause me personal liability. Just in general, we're walking around, we're always doing stuff, we're driving cars. I don't want to make that cash subject to anything that comes up there. So that's the way to do it. Somebody says my volume seems a little low. I'm going to keep cranking that thing up if there's any issues. Let's see where there are good questions. Are you able to list them along with the answers? No. Lots of questions. Let's just go to the next one. I know we have a ton to go over, so take a look at this one. I am married and want to start my real estate. This is one of my favorite ones. I am married and want to start my real estate business. My husband is not interested in any of these businesses. So the question becomes, what kind of businesses? Is this you're going to do an investment? You're going to be a real estate agent? You're going to flip houses, wholesale, etc. How should I proceed without interference from my husband for both tax purposes and asset protection? So here's where it really boils down. It depends on your state as to whether your husband's going to be stuck in this thing involved at all. So if I'm just a real estate agent and I set up a business, then the question is whether that business is, even though it's me individually, it's still considered a community asset, or whether it's a separate asset. And that really depends on the state. If you're in a separate property state, then it's you. Doesn't mean that your husband's going to be completely off the hook. And it doesn't mean that he's going to be nailed either if he's not an owner on it and it's just you. It's just if any of the money coming out of that business is used for community purposes, then the community is on the hook. If it's separate property and you keep it separate, then you really have to keep it separate. Then it's possible to protect him as well. So it gets kind of interesting. What I would say more importantly is whatever you do might be wise. And hey, Jeff, I can hear papers around or something on your side. It's coming through pretty loud. That's you. If you're having issue with the spouses, make sure that they sign off that they are not an owner in it. I would make sure that I'm doing that. And that's more of a structural. From a tax standpoint, if you're filing a joint return, it's going on your joint return. You'd have some innocent spouse relief if there was tax liabilities that for whatever reason you weren't reporting it and you weren't letting him know and he had no way to get it. There might be some protections for him. Otherwise, really what you need to be doing is just saying, hey, I know you're not interested in this and I'm going to run this separately, but I still need you to be aware of what's going on and just make your husband aware. Jeff, do you have anything you want to add on to that one?
No, if he truly wants to be completely uninvolved, he may want to file innocent spouse protection for himself to avoid any liabilities that might pass through to him on a jointly filed return.
And you're basically just saying, hey, I'm not involved in this, and I don't know what that.
Correct.
Mm-hmm. Yeah. I'm going to answer a few questions. But actually, no, let's keep going. Okay, let's jump on. I live in Illinois. Oh, this is another structure question. I live in Illinois, and I'm planning on starting a real estate business. I heard LLCs in Nevada, Wyoming, and Delaware are good. I'm just going to say caveat. They're good for certain things. But if you have a business in your state, for example, it says real estate business. So if it's rental properties, if it's real estate agent, if it's wholesaling, we're doing business in that state. You're going to have an entity in that state. So if I create an Illinois LLC, should I have any other of the three LLCs, or should I just create a Wyoming LLC and not Illinois? So the answer is almost always you're going to have an Illinois LLC, and that's great for inside liability. And that means that if something happens in that business, it stays inside that box. And sometimes we do a visual where we take a cardboard box and we take glasses representing each piece of property in each business. And we put all these glasses in the box and you close the box. And there's two things that you're looking at is, A, what if somebody wants to take the box from you? That's outside liability. Somebody wants to take that box, they would get all those glasses. And so that's where you use like a Nevada or Wyoming. I'm not really going to use a Delaware just because you use that for other purposes. But if I want to make sure that I have the best protection from outside liability, I'm going to be going to Wyoming first and Nevada second right now, just because it's a little bit cheaper to do Wyoming and they have the same statute and both protect and keep you anonymous. I'm going to go that route. Now you have inside liability, which the inside liability is what about what happens inside the box? We have all these glasses. And then the visual is we shake up that glass and we shake it and break all that glass inside it. That's inside liability. If you put everything in one box, then it's all subject to inside that. It's all subjected to that, anything that happens inside that box. So you really want to have boxes holding each glass, and you put those glasses inside a single box. And so that's the box that you're holding those LLCs. Each rental property, for example, if it's real estate, may go into an LLC, and they're held by the Wyoming LLC. Those local LLCs would be in Illinois, more likely than not. Cases where you go outside, like in California and some of these others, where it's exorbitant fee, but really what it is. I hope that helps. Jeff, did you have anything you wanted to add on that?
Nope, I think you pretty well covered that.
Okay, cool. Somebody says, is the $11.4 million free gift per recipient or per giftor, and it's per giftor. It's per person. You can't give 11 million away. Your lifetime solution. Are you getting that feedback? Are you?
No, I'm not getting anything.
Okay, I'm just getting it. Then I'm not going to worry about it. I'm getting some buzzing coming back.
And I'm getting a little breakup from you, Toby.
Okay, so that's kind of weird. I'm getting it. I'm getting buzzing. I'm getting it too. So I hear it. I hear it's ticking. Yeah, so something's coming through. It's kind of weird. I wonder whether it sounds like phone interference. Yeah. Hey, so Jeff, I'm just going to say this. It wasn't on there. If you have your cell phone, I would do that. And somebody says, I am faint and crackly. So maybe it's this, I don't know. Maybe it's my job, or I'll hold it up a little bit closer. Weird. I'm going to do this, and I'm going to put it back on. So, can you hear me now? I'm having some funky stuff going on with my audio, I think. So, Jeff, can you hear me?
I can hear you.
Okay, is it any better now? I just want to make sure that I troubleshoot this before I go any further.
Yeah, it's a little clearer.
Okay.
We're not getting a breakup or anything.
All right, so it could be something on this side. I'm on a Wi-Fi, so maybe doing that or maybe that. So I wasn't hearing it before, so I'm just curious. So there, we're doing however. If it keeps doing this, I'm going to. All right, the current limit on home mortgage interest deductions is a max of $750,000 for loans after 2017. Does that mean if you have a loan for $1 million, that 75% of the interest is deductible, or that none of it? What say you, Jeff? Well, I think we just lost Jeff. Let me see. Yeah, so that's where it's coming from. All right, so the answer, which I think Jeff just fell off, is that the current limit on the home office, you would get 75% of it. And then also that even though you have the 750,000, it's not after 2017. It's technically you're grandfathered in for loans prior to 2017, and then all the way up through April 15th of 2018 if you had that loan in motion before. So there are some little caveats there. Let me see if I can get through this. A lot of people are asking questions now. Nobody heard any problems there. All right, so let's keep going through. Some people really want, we're answering some of the questions. We don't need that. All right. One thing that you can do if you want to do some year-end planning, and we'll come back to this, if you use that little link there, we did a year-end tax planning live stream that if you guys want access to, it's available to the tax clients for free. We do these on a quarterly basis, but if you want to do the year-end tax planning, you can go to that little aba.link YETPS, which is year-end tax planning seminar, I believe. You can go in there, and what I did is basically broke down year-end tax planning for everybody. If you do something like that, I put a real simple guarantee. It's $197, and we guarantee that you'll save at least $2,000, or we'll give you your money back. It's real simple. And the reason that we do that is because if you do some tax planning, on average, it's going to save you about $1,000 per hour from what we see. So if you just spend a little bit of time on this thing, it's usually going to reap you some huge rewards. But if you want to take advantage of that, it's aba.link. I'm sure Susan will provide a link for everybody to use, and we'll get to that. All right. This is an interesting one, and I'll see if Jeff ever gets back on. If Susan, maybe you can just ask Paul to put him on a phone line instead of trying to use that computer. That's what was causing all the buzzing. I was hearing it. So we're having some computer issues there. All right, I have paid $50,000 in legal retainer in a litigation case in 2017. The fees were withdrawn throughout the year 2018. There's still credit on the account as not the entire $50,000 was used yet. This is a huge one, guys. And so the reason this is so important is because the law changed at the end of 2017. Prior to 2017, or in 2017, you could actually deduct as a miscellaneous itemized deduction your legal fees, your accounting fees, and things like that. In 2018, after the Tax Cut and Jobs Act, you cannot write those off personally anymore. So the reason this is important here is because that legal retainer is either going to be a refundable legal retainer or a non-refundable legal retainer. And if it is a non-refundable legal retainer, then the day they paid that $50,000 as a cash basis taxpayer, as an individual, you get that deduction in 2017. If it was a refundable retainer, then the fees are deductible when they are withdrawn, which would be 2018, and you would not get to write any of it off. So that's if it's personal. If it is business, then we have a little bit of a different scenario. If it's business, you can always write off business expenses. But if it is not business, then personal, then you're not going to get to write it off. So it gets a little bit funky. Hey guys, just real quick, just because we've been having a little bit of issues, a couple people said they can't hear anything. Just verify that you can hear me. I know I'm going to get inundated with a bunch of guys, so just maybe say yes, and that lets me know that everybody can hear. Yeah. So I just think it's Jeff that had a little issue. All right, so I'm going to keep jumping through these. Is keeping a log of miles always required? How should the car be purchased so all the miles are considered business? And so here's how this works. First off, you're always required to keep track of whether something is personal and business use, unless it's 100% business use, in which case all of the miles are business, but you should still be you're supposed to keep a log. And the easiest way to do that is by using an app like Mile IQ. If it's business, you may have the GPS already put into the vehicle. I know that most companies do that, most common carriers do that, and many are actually required to do that in many different types of industries. But yeah, so the easy answer is keep track of your miles. You could start at the beginning of the year, write down what the odometer is, and then keep track of which trips. If you're using a Mile IQ, it's real easy because it GPSs and tracks all of your trips. And if they're all business, then it's really easy. But that car better be parked at that office or parked at the lot. It should not be something where you are. I can hear you again, Jeff, and it's pretty. I think you just came back on. But you're keeping track of those miles. If it's on the app, super simple. If it's something between being used for business and perhaps being used, maybe you're using it for a commuting car and things like that, and it's not 100% business, then I would say you really want to use Mile IQ or a similar app. And then you can designate which trips are always business. So like if you're constantly going between a home office and a business office, for example, you can set that and forget it, and it always grabs those trips and makes them a business trip. How should the car be purchased so all the miles are considered business? It has to be purchased by, or basically, I don't even have to say it's purchased. It's all the miles have to be used for business. So if you own that car personally and you're reimbursing the miles, then all the miles are considered business if they are business miles and you're tracking them as such. So if I own, Jeff, are you back on, or is that Susan?
Can you hear me now?
Yeah, I can hear you now. Are you on a phone?
No, actually, we switched out microphones and.
Oh, okay.
So
that mic was driving me crazy. I think it was what was causing all the static. Not just me,
Yeah.
but I think.
Yeah, I wasn't shuffling papers. I didn't even have any papers to shuffle.
Okay.
No, the one thing I thought about with this question was how should the car be purchased? It doesn't matter so much how the car is purchased as it does how the car is used.
Yep. 100%.
And if you want to depreciate it, it's going to have to be purchased within the business entity. Although the mileage factor does have a depreciation part of that.
Yeah.
Part of that.
If you're reimbursing miles, you're not depreciating it. If you're depreciating it, then you're not reimbursing miles. That depreciation is already built into the amount, right?
Yep. And we occasionally have clients that try to do both, and we re-educate them.
You can't do that. The big issue is there's basically a couple different ways to write off vehicles right now. You have the 179 deduction and you have the bonus depreciation, and they both have goods and bads, good and bad things along with them. So for example, if you're doing the 179, then if you have an SUV that's even over 6,000 pounds, you have a $25,000 limitation, when if you have a bonus depreciation, you're over 6,000 pounds, you could just write the whole thing off in year one. Somebody just said, what is the best option to depreciate or mileage? It depends, Mariana. So realistically, I tend to go where there's no harm, no foul, which is miles. I agree. It's really easy for me. If I buy that vehicle, and I don't use it more than 50%, then I stand a chance of getting nailed with ordinary income for the value of the vehicle that I wrote off if I drop below 50% during the 5 years following. So there's little traps that are out there. And so I tend to look at this and say, what's the easiest way not to screw it up? And the easiest way not to screw it up is to do the mileage reimbursement.
And another thing I see is people who are trying to do actual miles. I see they tend to miss a lot of their expenses. They're not keeping gas receipts or repair receipts. So they would actually end up doing, and often they do better with a mileage reimbursement.
Yeah, and you don't have to worry about how long you've had the vehicle or how valuable the vehicle is. I could have a truck that's 20 years old, and I could have another car that's that brand spanking new. They're both, whatever is it? I think it's 54.5 cents a mile right now?
It's 58 cents a mile right now.
Let's jump back up. So 58 cents a mile, you're reimbursing. So if you're doing 10,000 miles, that means you're handing yourself a check for $5,800, and you're not reporting it anywhere. It just shows up as an expense on the company. In order to do that, you would have to be a C-Corp, an S-Corp, or a sole proprietorship, right? I guess you could write off miles technically as a partnership. It's just you're not getting when you're doing the reimbursement, you want to make sure it's non-reportable. Then
correct.
You really need to be the S-Corp, C-Corp, or a qualified nonprofit. All right, let's jump on. I sold an investment property in 2018 that I'd owned for more than 20 years. What is the tax liability on the sale of an investment property? What are the options for mitigating the tax liability? What say you, Jeff?
Well, I see three different possibilities with this. One is you 1031 exchange it, which means you are selling your property and replacing it with another property.
They already sold it, though. So they sold it in 2018.
They could still do the qualified opportunity zone. That would accomplish more or less the same thing. There's some other tax benefits, and I know we talked about the opportunity zones. And my third choice is if I got securities or something with losses, I may just want to dump those stocks and take the losses now to apply against any gains I have on my property.
Mm-hmm. The only thing is I don't think you can still do the opportunity zone. I think you're toast just because they're 2018. You would have had to have done that in the first half of 2019. I think that realistically, the tax liability they're going to be looking at is On the gain, they're looking at long-term capital gains. And so that's going to be 0 to 20%, depending on what your tax bracket is. On the depreciation you took, your recapture is going to be at your ordinary rate, capped at 25%.
Right.
And there's not going to be a way to defer back in 2018. If you didn't do anything, you're done. If you were doing it this year, then I'm right with you, Jeff. If they hadn't sold it yet, then they could do a 1031 exchange and roll the whole thing forward. They take their they take their basis and roll it into the new property. So they have no tax, they have no depreciation recapture, they have no long-term capital gains.
And the first thing I thought about with this question was it's a 2018 sale, so it should have already been reported.
Yep.
Unless it's a fiscal year corporation.
Yeah. So again, if somebody was now and, maybe they did this and they were thinking they were going to, maybe they haven't reported it yet, or maybe they reported it and they got hit with the tax liability and they don't know what to do. But the fact of the matter is, we could just say, let's pretend this is 2019.
Right.
And you've owned this for a long time, then you've already sold it. Then you're really limited to a couple things. Number one, you're going to be recognizing that gain in that depreciation recapture. You could reinvest it in a qualified opportunity zone and defer it for up to 7 years if you did that during 2019. The other thing you do is you look for your losers and offset your gains by selling properties that have lost, and they offset each other. So you can always try that route too. Other than that, I think you're kind of toast.
Yeah, I mean, you're right about the opportunity zone. 1031 is not going to work because it's already sold. The opportunity zone is not going to work because the time's already expired from a 2018 sale.
Mm-hmm.
So.
All right. Somebody asked, what's the name of the mileage app? It's Mile IQ. Has the IRS stated the mileage amount for 2020? Did they already? I think they came out with that.
Mileage, I'm not sure if it's come out or not.
Yeah.
I will check.
2020. They may have come out. They always adjust something. I know that they just came out with something 2 weeks ago. And somebody says, I have a truck and a car. I never use the truck for personal. Must I track miles? Do you always have to track the miles, even if it's 100% business use?
I want to say you do, because you need to be able to prove that it doesn't have a personal factor to it.
Yeah. My understanding is that you have to, even if it's all business, you're still keeping a log saying, see, in other words, you have to show that the vehicle is being used for business. Otherwise, it's presumed that it's going to be not business.
Right. I mean, the way the audits work is IRS gets to prove your income, but you have to prove your deductions. So to say that this is 100% business, they're going to say prove it.
Mm-hmm.
Oh, and the mileage rate for 2020 is 58 cents.
58 cents, all right. Is it 2019 that it's 54 and a half? I just had that stuck in my head for some reason.
I want to say it was 2018.
Yeah, shows you what I know. All right, maybe it's because I was looking at it. All right, somebody says, what is the largest amount of adjusted income you can have and get the 0% capital gains tax? Married filing jointly, I think it's 20 or 78,000 and some change. And then for a single person, I don't know what it is. You may have the numbers sitting there. It used to be the lowest brackets, and then they just made it a set taxable amount. So.
Yeah, I don't have it off the top of my head what the brackets are.
Mm-hmm. And then the other one is, let's see. And Jeff, are you able to hear me okay? I keep having people popping in and saying that that I sound distant.
I'm hearing you pretty good.
All right. So
pretty well.
All right. So, all right. That's funny. You're fine. I've had like 3 or 4 people say they can't even hear me. So I'm like, all right. That's probably a computer issue on the side of the recipient. All right. Somebody else says, for this gain, can you offset stock market losses against that real estate gain? So I know
the capital gain portion you can, but not any recapture.
not any recapture. So if you have stock market losses, you can use the stock market losses to offset your gains on real estate.
Yes.
Huh.
So for a capital gain, it's a capital gain, and you can offset any capital gain with any capital loss.
Now, keep in mind that if you have long-term capital losses and you have short-term capital gains, that's a great scenario.
Yes.
Because that long-term capital gain would have only been like, that's a lesser amount of tax against something that's larger. So anyway, 2019 was 20. Yeah. So somebody else is putting this up is 58 cents. I'm thinking that 2018 was probably 54.5 cents.
Yeah, it was.
Yep. All right. So let's see what else we have. There's a bunch of questions, but none of that are really relating to that. So let's keep going on. And here we go. I like that question, though. I mean, it's sad because that's the question you're supposed to be asking before you sell the property. All right. I have an LLC taxed as a C-Corp that manages my rental properties. It will not pay any wages and will operate at a loss for the next several years. What you're allowed to do as a C-Corp, by the way, it's Section 183 is the hobby loss rules, and it's only applicable to partnerships, sole proprietors, and S-Corps. It will provide fringe benefits, okay? Can this entity sponsor a self-directed 401k plan to accept rollover contributions? And the answer is yes, it can. Yeah, you don't have to continue to contribute to a 401k. If you have a bunch of IRAs or rollover from a past employer, you can roll them right into that 401k, and you never actually have to contribute to it. You just have control of it. So it's a great vehicle. And the big difference between an IRA and a 401k, if you don't know, is that IRAs you cannot borrow from. And if you borrow money in an IRA, you have something called unrelated debt finance income. So if you do any real estate in your IRA, it's a problem. That is not true of a 401k. I can borrow money from my 401k up to $50,000 per participant, up to 50% of the plan assets, or the assets, my plan assets, my portion of it. And it is not subject to unrelated debt finance income. So, and, just to throw it in there, IRAs require custodians, 401ks do not. So you could actually be your own trustee of a 401k, and you don't even have anybody that you have to ask to sign on to things. So quite often we have real estate folks, and they're doing that self-directed IRA. You may want to consider a 401k. It's a lot easier to use. And as this question illustrates, if you have an entity that's floating around out there, you can hang a 401k off, but you don't have to contribute to it. Even if you have employees, you don't have to contribute to it, because you don't have to worry about discrimination when you're not actually putting more money into it. Anything you want to add on that one, Jeff?
No, I mean, that's exactly right. And if you want to make contributions or have the employer make contributions later, you just need to run some salary so you have something to base those contributions on.
Yep. Well, somebody just asked this. I'm a licensed real estate agent and I have investments and drive for business also. Do I have to track miles separately? So do you have to keep your business miles different from your investment miles? And I would say, yeah, you want to track them so that your one business is reimbursing you for certain miles and your investments are reimbursing you for others.
Right. Generally, you want to keep each activity separate for mileage.
Mm-hmm. All right. Let's look at the next one. What is your opinion on cost segregation software, which can allow CPAs to prepare cost seg studies for $400? Is there any disadvantage for this versus physically sending someone to the property to do the cost seg? I have very strong views on this. Jeff, do you want to take a shot at it first before I spew?
I can only regurgitate what we talked about earlier. There are some disadvantages of the CPA software doing the cost segregation, and that you're probably not going to catch every dollar of savings that you could with having the engineers go out and take a look at things.
Yeah, the biggest issue is, so there is no standard for who prepares the cost seg study. First off, there is no standard that the IRS has There's no standard that the Congress has set forth. IRS has said in a chief memorandum, oh gosh bless it, I forget the chief office memorandum, that they want a qualified person, and the audit guide requires that as well. So we look at what the IRS is going to say. And for those of you guys who are scratching your head going, what is a cost seg? A cost segregation study is when you take a structure and you break it down into components. The reason you do that is because a structure, let's say a commercial structure, has a useful life of 39 years. So you would take 1/39th of its value and deduct that every year. And then we're talking just the structural value, not the land. So if you want to speed that up, you find its components, and then you have different useful lives. So for example, the carpeting and the wallpaper and things like that might be 5-year property. The sidewalk might be 15-year property, and the electric system might be 7-year property. So you're going through and you're looking at all these different things, and that allows you to rapidly depreciate them. Because the Tax Cuts and Jobs Act added this bonus depreciation, then if you put something into service in 2018, 19, 2020, 2021, or 2022, you get 100% bonus depreciation, meaning that anything less than 20-year property you can write off in the first year. So what it means is you get a huge, big, fat write-off on some of these things if you do the cost seg study. So then it becomes, well, should I pay somebody a lot of money to do a cost seg study? The cost seg studies have gone down considerably. It used to be they were all $10,000 to $15,000. Now you're getting down to $1,500 to probably some of the most expensive ones I've seen on multiple properties were in the $13,000 to $14,000 range. But you're generating a huge tax benefit, which generates a huge cash benefit. So here's what they came up with. They have these companies out there that do these cost seg studies for $400, and they say, "Hey, CPA, you do the cost seg study." But the problem is when the IRS says what is a qualified individual, it's somebody who's an expert at the components and breaking them down. So I don't know too many CPAs that could walk into a building and figure out the value of all the different pieces in that building. I know engineers that can do that, and so I'm just going to say I'm going to side on the air of caution and not do the software with the CPA, because chances are I do not have a qualified individual involved in that transaction, unless your CPA is an expert at real estate and knows how to break down the components. Now, that's not a slight on CPAs. It's just that my experience is that most are not that adept at the real estate that they're going to be able to walk into a building and say, by the way, the electric system is worth $43,615 because here's all the components of it. And so as a result, what a lot of these low-cost cost seg studies do is they get very, very conservative on what they allow you to deduct. So they might be 20% of the structure, as opposed to if you have an engineer come in there, they might be 30%. And what you just did is you went price over value. The value of having done an actual cost seg study is far greater when I use a qualified professional. And keep in mind, I don't do cost seg studies. We've done webinars with some great companies, Cost Seg Authority and Eric Oliver. They're great. We have some specials with those guys where they'll do a free analysis for you. I think it's Anderson Advisors /CSA if you ever want to get a cost seg done and get the quote for free. Fantastic groups, but I don't have a dog in the fight. I just look at it and say, hey, for my clients, I want to get the most out of it as humanly possible. Now, a bunch of guys asked questions. You said, does it make sense to do a cost seg for a single family residence? And the answer, Daniel, is it depends. It depends on how much the cost seg study costs and how much it's going to put in my pocket. If it's going to save me $15,000 and it's going to cost me $1,500, I might do it. And when I say save me $15,000, that's the tax savings. Usually a cost seg study done by an engineer is going to, you take whatever that structural value is, and it's going to be somewhere between 25 and 35%, somewhere in that range. Low end, 20%. But it's going to be a pretty good size. So if I have a $200,000 structure on $50,000 of land, I'm probably looking at a $40,000 deduction, which could save me a considerable amount of money depending on what tax bracket I'm in or what state I'm in, and whether the state's going to recognize that cost seg study. Those are all little pieces. I have a big fat cost seg write-off, bigger than my income for the year. Should I take the whole thing in year one and carry forward a negative depreciation, or space it out over 5 years? Carolyn, that's up to you. You don't have to take the huge cost seg. You could take it and carry forward the loss. And depending on whether you're a real estate professional, it may offset your W-2 as well. If you already own the property for years and been doing depreciation for the whole building, can you do a cost seg and depreciate the components starting this year? Yes. So Tien, we actually did that this year on a building that I acquired in 2003, and we chose to do it simply because it was very profitable and knocked off about $250,000 of income that building kicked out, so we didn't have to pay tax on it this year. How often can you do a cost seg? You do it once, and it is a change of accounting methodology. Let's see if there's another one for a cost seg. Can I utilize the benefits of professional offsetting W-2 income? Yes. So if you're a real estate professional, you could actually take that loss that you have and offset your W-2 income. So it really comes down to whether it's worth it for you. Quite often, I always look at it as like worst case scenario with the cost seg is you're getting an interest-free loan on that money ahead of time. So yes, I would write it off over the next 39 years anyway. So if I take a big cost seg benefit now, it means I'm not writing it off later, but I have that money in my pocket now. And especially if I'm in a high tax bracket, then it's a no-brainer. Somebody says, what if I acquired the property in 2017? Then it would be the bonus depreciation in 2017, which I think, Jeff, correct me if I'm wrong, I think 2017 was 50%.
Correct.
Mm-hmm.
So, yeah, we can always go back, and we can go back a number of years to do this change of accounting method. If you do the cost segregation in the year you purchase a property, that's not actually a change of accounting method. You're actually establishing your accounting method when you file your tax return.
Yep. And when you do that, let's say you had 50% bonus, that doesn't change. That's everything that's under 15 years. You could choose to take the bonus depreciation of 50% on the 5-year property, the 7-year property, the 15-year property, or all of them. Does a cost seg matter for a buy and hold or a flip? It's really the buy and hold. Somebody says, what about the opportunity zone? I'll hit that. Actually, I'm not sure, Seth, what you're talking about. I'll go through and see if there's an opportunity zone question coming up. We'll knock these things out. And then if you refinance or the property that does not reset your basis, no, it does not. For redepreciation, no, it doesn't quite work that way. If you improve a property, let's say you refinance it and you do an addition or something like that, then yeah, you can. Does bonus depreciation affect depreciation on a state return? It depends on the state. Like California doesn't, other states do. And specifically starting a business in an opportunity zone. Oh, yeah, we could talk a little bit about that. Here, let me keep going through our questions. I'll try to hit that here in a second. If I make a large stock contribution to my 501c3, are there any capital allocation or income sourcing requirements that would force my charity to sell it off?
And there isn't anything I'm aware of as far as capital allocations or income sourcing requirements. But the one thing I did think about was you have to fulfill the nonprofit's purpose. And its purpose is not to hold stock, hold securities. So you're probably going to have to spend some of this. You're probably going to have to cash in some of the stock in order to fulfill that nonprofit's purpose.
You might. I don't think there's any law that requires that you dump it off. It depends on whether the stock is producing dividends that you're using. You know, at the end of the day, is it helping you fulfill your purpose? And somebody giving your company or a company and it doesn't, so it says my 501c3. 501c3s are not owned; they're only controlled. So if you control a 501c3 and somebody transfers in a bunch of stock, as long as it's helping it fulfill its purpose, we don't really care. And
Correct.
frankly, the IRS coming in there, I can see it if you own too much of a company that you are also a partner in, that we may have some issues. And I don't know off the top of my head the precise rules, but it's usually if you're a publicly traded company and you have too much of it. But anyway, somebody just asked, this cost seg just won't die. It's always interesting. You can do families, condos, any type of real estate. You can do cost seg on. And number two is there a difference between bonus depreciation and Section 179? Yes, bonus depreciation is Section 168, and it's any property with a useful life less than 20 years or less. You could choose to bonus that depreciation and take up to 100% in the year of acquisition right now, and it can be used or new property. Section 179 is for equipment and allows you to write off up to $1 million in year one. The big difference is Section 179, if it drops below 50% business use, it's all ordinary income. You have to recognize it all back. So it's much safer to use bonus depreciation. All right, let's go on to the next one. Sorry, Jeff, I hobarted that. I know you like going into some of that stuff too. All right, the loss from one pass-through rental LLC exceeds the gain of another. The LLCs are in different states. Do I pay state income tax with the profitable LLC even though I have federal losses? Jeff, why don't you whack this one out?
Well, how state income tax works, if you're doing business in a state, whether it's a rental, that state, assuming it's not where you live, that state is only looking at the income earned in that state, which on the other side means you can't apply losses from other states into that state. Now, your resident state, if they have an income tax, say California, Arizona, you're gonna pay tax on all of your income, regardless of what states are in. And how that actually works, you're not getting double taxed. You're usually getting credit in one state or the other to offset the duplicated taxes between states.
Mm-hmm. And then the federal tax, they're right. They're going to offset each other. So you have rental activity, it's all passive activity. All your passive losses and all your passive gains are offsetting each other. The only issue you have is that you can't take passive losses and offset active gains unless you fall under one of the exceptions. And the exceptions, when you have a passive, is really only for real estate, and that's if you're an active participant in real estate or a real estate professional. The active is a $25,000 loss, and it phases out between $100,000 and $150,000. So it's maybe not the greatest thing. And then real estate professional, it just goes for anything, and that just changes your loss from passive into active.
And something that often comes up is when we have losses in a state, people will sometimes say, well, if I have a loss, I don't have any tax. Why do I need to file a state return there? I personally like filing those state returns so I can build up my losses in that state. Okay. So if I do turn around down the road and sell the property, I have a big loss that I may be able to apply against any gain on the sale.
Can you touch on that? Because I bet you a bunch of people don't realize that passive losses get released when you dispose of an asset.
Right. So if I have two properties and one is just generating losses and losses and losses, I am building up all these what we call the passive activity losses. They're called suspended. Where I'm not using them. They're just sitting there. And they're waiting for one of two things to happen. Either I'm getting passive income from another source, maybe my second property is making a lot of money and it's passive also. Or when I sell that property, it releases all of those passive losses that have been suspended. So if I have a property and I sell it for a $100,000 gain, but I may have $50,000 worth of passive losses on that property. So I'm going to actually end up paying tax on the difference between those two. Mm-hmm. On top of that, the gain on sale may be capital gain, and the passive losses received released are going to be ordinary losses. So there is a little bit of a bracket advantage there too.
Yeah, and ordinary losses, just remember, like for folks out there, that means it offsets even your W-2 income. It's any loss, like it's active loss at that point.
Correct.
Yeah, so I just had this question come up with somebody who had been sitting on a loser property, and they were losing money every year, and they said, hey, they had like $125,000 of passive losses accumulated in this property. And I said, why aren't you dumping that? And they said, well, because it's negative, and I'm not going to be able to use the negative. And I said, what are you talking about? Well, it's passive. And I said, well, okay, so how much are you going to lose on the property when you sell it? And they were like at 25,000. Well, they had 125,000 of passive losses that were suspended. I was like, you're going to get a pretty massive tax loss. 125,000 of suspended loss will be ordinary because you're disposing of that asset plus the other 25,000. So I was looking at their tax return. It was about a $60,000 savings to them by getting rid of that property. So they looked at it saying, I'm losing 25 and I don't get to use any of it. I'm looking at it saying, you're going to have $150,000 tax deduction against your ordinary income. Why aren't you selling this?
And this is something you have to keep in mind when you're doing your tax planning is if I got a property that's just killing me, but I got a big windfall bonus or whatever, that I have a lot more income than normal, this may be the time to get rid of that loser property.
Yep. And if you're going to convert, like let's say that you were doing a conversion, you had your IRA, you just took control of a 401k from a past employer, and you're thinking of converted that to a Roth, and you're like, you're hearing everybody talking about a Roth. If you have a suspended loss, that's the year to take it to make your income, get it as low, almost as to zero as humanly possible. So when you do that conversion, you're not paying much tax on the conversion. You're going to be at 0, 10, 12% or something like that. You're going to be really low. Then it might make sense to do that conversion. Otherwise, it almost never makes sense to do that conversion later in life.
Right.
Do that Roth. But if you're able to create a big tax loss, that's when you start selling some things. And gosh, this is another one we like during. I mentioned, guys, that you could do the year-end tax planning. One of the big parts of tax planning is you look at it and say, hey, wait a second, I could sell something at a gain that may be in a 0% tax rate. So like I looked at a married couple that were making $70,000 with their standard deduction. They were below 50, and they had gains in the stock market of about $15,000 on a stock. And I said, sell the stock, capture that gain. It's at 0%. It was long-term capital gains. And I said, then buy it back immediately. And they said, you can't do that. My accountant said there's a wash sale rule. And I said, it's the wash loss. You can wash gain, like you could do that all day long. It resets your basis when you buy it back. And I said, now you have that $15,000 you never pay tax on again. It's
correct.
So do that stuff, but yeah, you really again, it's stuff that you need to be looking at. Again, if you want to do that year-end tax planning live stream, the link's there. I could see Susan put it up. Those are the types of things you're looking at, and you want to just go through checklists, and that's exactly what we're doing. Is you're looking and going check. Is there any way I can get a benefit on this? Anyway, oops, what did I just do? Let's go back. If you buy a house as an investment property, hold it for 5 years, take depreciation for 5 years, sell it, doing a 1031 exchange, what happens? Do you have to pay the depreciation back when you do the 1031 exchange? How does it work? Jeff, do you want to knock that one out?
When you do a 1031 exchange, everything is deferred. Not only the gain on sale, but the depreciation recapture is also deferred.
Absolutely.
And how that really works is if I have a property and I'm depreciating it for 5 years, when I get my replacement property, the best way to do this is you keep depreciating the old property, but then you have a new asset for the difference in the two properties is how it works out. And then when you do that and sell the replacement property again, you would recognize that depreciation recapture. But when you do these 1031 exchanges, if you do them right, there is no tax to pay at all, not even the recapture.
Mm-hmm. This is funny. There's a couple of really cool ones that people are asking some questions. So passive losses in rental can offset active income. Harmeet, yes, if you can meet one of the exceptions. It's if you are an active participant and you make less than 150,000, phases out actually. So 100,000 is the magic number where you get the full 25, or you're a real estate professional, which is 469C7, and all that means is it's 750 hours or more than half of your personal services are in real estate, and you materially participate. And one spouse can meet if one spouse has to meet the 750 hours, the material participation is both. Somebody said, if you have passive losses, K1 in a state, and haven't been filing taxes, is there a way to still incorporate losses in that state? So can you go back and track all your losses, Jeff?
I've actually seen it done both ways. Sometimes the state just, when you file a state return, it picks up whatever federal loss is being released. Because technically you're not even reporting a loss in that state. It's suspended, and once the federal loss is released, it'll usually pick up on the state return.
Right. Now, somebody has said, here's another fun one. Number one, I buy property. Number two, I cost seg and bonus depreciate. Number three, sell property and apply losses on active income. Number four, profit ? Doesn't quite work that way. When you're taking bonus depreciation, that's a deduction, and you have to recapture your depreciation. Actually, when you're doing cost seg and bonus depreciation, it's ordinary income based on the value. So if you sell the property right away, whether or not you have a loss isn't necessarily applicable based on that bonus depreciation, which could be what you paid for in your basis in the property. So it doesn't quite work that way, Craig. It's it would be really neat if you could. Let's see. Somebody says, can you explain more about the stock recapture? How do I know when that is a good idea? Is there a particular IRS form that needs to do this? Stock recapture. I'm assuming that you're talking about the selling gain and offsetting loss. And when is it a good idea? Well, the best idea is when you have long-term capital losses that offset short-term capital gains, because that short-term capital gains would be ordinary income. So you have a loss that would be maxed at 20%, offsetting short-term gains that could be as high as 37%. So that's a great situation. The other one is you're looking for any time your long-term capital gains rate is in the 0 to 15% range, and you want to reset, like you've owned stock for a long time and you want to reset its basis, then you sell it, you pay the little bit of tax, or in many cases the zero, and no, you're not having it. Where is it being reported? They're sending you. So somebody just said the click something weird thing. I don't see the questions. Mina, you're not going to see the questions simply because there's too many personal questions that people ask, and we don't want them to see your questions with their name next to it, just because this is recorded and it'll be really bad to have some of that stuff floating around out there. We want people to be able to feel free to ask their questions. Somebody says, what kind of structure for selling stocks? That's a big one. You want to make sure that you're in a partnership for the stock account or a corporation, and that partnership has a corporation as its as one of its partners if you are doing that. And the reason being is because you want to have a guaranteed payment to partner to allow the expenses. You cannot expense most anything as an individual investor. You can't even expense management fees. They're itemized deductions, and now itemized deductions are gone, so you don't get to write that off. You don't get to write off workshops, conventions, travel, meals, all that fun stuff. All that's gone out the door if you're an investor. So when you're doing stock, you almost always want to have it. You always want to have that in some sort of entity. Can you 1031 exchange into a property you already own from another? No, you cannot. You can do brother sister. Somebody says or a C or S Corp or LLC. So an LLC is not a tax type. It can be an S or a C, but either one would get you where you need to go. I would always defer to the C Corp whenever I'm doing something. All right, let's go to the next one. The reason being is it's not you. It's even more separate from you. I am initiating the sale of a California rental property that was held in my personal name. I will initiate a 1031 exchange, but would like to put it in an LLC for asset protection and tie into our management C Corp to pay expenses. I get what you're doing. And the answer is, whenever you do a 1031 exchange, you have to sell in the same name that you buy in. And so but that doesn't mean that you're done. It means that you're going to buy, if you're going to sell in your personal name, and then you're going to buy the replacement property or properties. And yes, you can buy multiple, anything that's real estate qualifies. So I could sell one piece of real estate and buy 10 condos, or I could sell 10 condos and buy one piece of real estate, as long as my replacement property exceeds or is greater than those values. Typically, you're selling a rental property, you might be buying, 2 or 3 different pieces of real estate, especially if it's California, right? But once you close in your name, you can put it in an LLC afterwards, but you have to close in your individual name, and then you would drop it into an LLC afterwards. So that would be a swap. That would work. Anything you want to throw in on that one, Jeff?
Well, what if they dropped the property into an LLC before they sold it?
Then you would buy in the LLC, as long as they're going name to name. So you could go either direction. It's called a Starker exchange when you do that delayed exchange. I sell a property and then I buy one and close within 180 days. I identify a property within 45 and then I close. They've had it to where people bought it and then immediately dropped it in the LLC. And it used to be practitioners said, oh, you got to wait a little while. You got to wait 6 months. There's nothing on there. The IRS hasn't barked at it, and there's actually cases to the contrary. So I would opt for the sell in the same name to make sure you had that it's an investment property and that you don't make it look like it was a flip by putting in a different name that is sold immediately thereafter. Realistically, you want it to be in the name that it's been the last year, and then you want to sell it. So it's definitely an investment property. You use your same name and then you drop it in the LLC. That's going to be the safest. Hope that helps. Is a quitclaim deed sufficient to transfer the title of a timeshare from a personal name to a revocable living trust in California? So they're assuming that the timeshare is held by title. Then can you just toss it in there via quitclaim? Technically, you can. The reason that most people use warranty deeds is because if there's title insurance of any kind, you could void it out by quitclaiming.
And I thought the same thing, that people need to look at their contracts and see how the ownership is, because it could be a deeded interest. It could just be a right to use contract.
Yep.
And if it's a right to use contract, I believe you can assign that interest to somebody else. Is that correct?
Yeah, you could just assign it, and you could literally just assign it into your living trust. In fact, most time you do a revocable living trust, it's going to say anything that's non-titled, I hereby assign into my trust to myself as trustee of my living trust. Is technically how you do it. And what that does, for those of you guys who don't know, especially in California, this is a big one. If you own something personally in California and you pass, you're required to go through probate, which is a court-appointed process to transfer the title on that asset. The problem in California is it starts at 8% between the lawyer and the personal representative as statutory fees. So whatever the value of your estate is, it gets pretty expensive. It phases down as your estate gets bigger, but it's still a really large amount of money. I think on $1 million, it's almost 30 grand. It's quite a bit that's going to lawyers and personal representatives that you don't need to. If you simply use the living trust, that entire thing is avoided. So it's a really good idea, because timeshares aren't cheap, to transfer them into your trust so you don't die and have to deal with the transfer afterward. I'm just going to peek at some of the questions that are coming in, Jeff.
Yeah, I think a quick claim might be sufficient, but I would probably go ahead and do a warranty deed to transfer title.
Yeah, somebody says, what about a timeshare in Florida? It depends on whether it's titled or not. Again, it's right to use. Well, somebody says, oh, here's a good one about that 1031 exchange. If a property is under an S-Corp, can we still do a 1031 exchange? Yes. And then change to an LLC after the 1031 exchange. We don't want to keep the property on the S-Corp because there's no step up in basis when the owner passes away. Tian, that's not exactly true. If you pull it out of that 1030, if you pull it out of the S-Corp, the appreciation is going to be treated as wages to you. So you don't want to do that. But you do get a step up in basis in the S-Corp when somebody dies. So when somebody who owns the S-Corp passes, the basis steps up. So then you could deal with some things there.
Right. If you do a 1031 in the S-Corp and then pull it out, you're going to defeat the whole purpose of the 1031.
Yeah. So don't do that. It'll save you a lot of heartache. Let me jump. There's a whole bunch of questions coming in, but I think we need to still, I know we're late already, so let me just keep doing. If you have a HELOC on your personal residence, which is in your personal name, and you use the HELOC to buy and renovate homes for your business, can you still deduct the HELOC interest as a business expense? Jeff, I know this is right up your alley.
Yeah, I mean, I'm actually fine with this. We kind of do the same thing when the owner of the company is using their credit cards for business expenses. And IRS has even said that as long as you are recognizing the expense in the proper place for who the expense was, it's fine.
So this is the big one for you guys out there. That you're not writing it off on your Schedule A as a mortgage interest expense. You're writing it off as a business expense, and the company is essentially just reimbursing you for the fact that it used your interest. You don't make any money. You don't get any personal tax benefit unless it's an investment property and it's on your Schedule E, but you're getting to write off that interest as a business expense. Did I say that right, Jeff?
Yeah, and we even see like somebody will use a HELOC on their personal residence to buy another property, and that interest would rightly belong to the purchased property, not the personal residence.
Yep. So somebody asked a couple questions about the recording, by the way. They said, hey, if you do my taxes, do I qualify? Yes, you should have been doing the quarterly planning, so you should get it. If Anderson prepared my returns, do I qualify for the recording? Yes, you should actually reach out. We should have sent you, like we did it a couple weeks ago, so you should have been had access to that in the recording. Then somebody says, I'll listen to the video. I'm not going to go over all this. We'll just jump in. All right. Yeah, so the year-end planning recording, if you're a tax client and you did a tax package, you get that. So I want to make sure you're actually participating. Anybody who is a tax client, and Jeff, this relates particularly to your division because Jeff oversees the tax folks. That year-end tax planning is the quarterly meeting. It's the year-end we specialized on the year-end tax planning. When I did my last tax-wise in November, I also did a section on year-end tax planning. I think if you did the tax-wise, you're probably pretty good. It's a lot of the same stuff. It's just, again, planning is planning. It's laying things out. It's going through a checklist. I probably was a little more systematic on the webinar, the live stream that I did, than necessarily in the tax-wise, where we're going over a whole bunch of different strategies. Tax-wise, they're fun, by the way. I think we had 33 strategies this last one. It was a ton of fun. We're getting ready to get all the schedule out for next year, so make sure you do a tax-wise workshop if you haven't done it. I am closing a condo under my name, but I would like to have it under my LLC as I will rent it out. The problem is rates are a lot higher for a commercial loan to an LLC. Yes, they are, and they're a pain in the butt to get. So I was thinking of getting the mortgage under my name and then transfer the title to the LLC after the closing. Is this a problem? No, it's not a problem to transfer it into the condo into the LLC. The issue you're going to have is that if your mortgage company catches wind of it, they may say, hey, due on sale clause. We're not going to agree to that. So the workaround generally is just to use a land trust And the reason being is because most mortgage companies think of trust as living trust, and it's a revocable trust. And you give them a version with you as the beneficiary. They go, okay, we don't really care. And then you just assign the beneficial interest to your LLC. And it's the same thing as transferring it in the LLC in the first place. Because if anything ever happens on that property, they want the beneficial use, the right to occupy, rent it out, sell it, and all those things. And that goes with the beneficiary of the land trust. So sometimes when you have a property that has a mortgage on it, the mortgage companies won't let you move it over to an LLC, which most won't. You end up using a land trust, and it gets you to the same place. Jeff, did you have anything you wanted to add on that, or we're just keep busting through these?
Keep busting through.
Yeah, I picked out a lot of questions, so I apologize, guys. This is a long one, but sometimes I do that just because I was sitting here in the sun and I must have had heat stroke when I said, let's do this many questions, but what the heck. All right, I have a holding LLC and subsidiary LLC with rental property in it. I need to put some expenses on a company credit card. Can I use a credit card for the holding LLC and have the subsidiary LLC checking account pay the credit card bill, or do I need separate credit cards for each LLC? Technically, you don't need a credit card in any of the LLCs. It can always reimburse you if it uses yours. If you have a holding LLC and you have a credit card, that's going to be sufficient. The subsidiary LLCs, I'm assuming, are disregarded LLCs. So for tax purposes, the IRS treats it all as one big enterprise. Anyway, since it's a holding LLC, it's going to be able to incur expenses. If you are particularly worried and you're like, oh my gosh, I want to make sure that I never have any commingling whatsoever, and I want to make sure that I don't have any expenses somehow being attributed to that holding LLC. You're like, maybe you have a lot of assets and they're really expensive, then maybe you would set up one, but frankly, no, you don't have to. It's certainly not a requirement. Technically, it's not a requirement to have separate checking accounts. It's just a factor that the courts look at for separateness. So from a tax perspective, it makes zero difference. But from an ease of use, again, technically you don't have to have the holding LLC have its own credit card at all. In fact, when you have a management company, management corporation, I should say, LLC taxed as a corporation in the mix, usually that's where the credit card is. Is there anything on that one that you want to throw in on, Jeff? Or are you good?
No, I agree with that. There's no reason to have a credit card for each LLC. And like you said, not necessarily even having a bank account for each separate LLC. It does make things a little clearer for liability protection, but for tax, it means absolutely nothing.
All right, you guys have done a great job today. Just remember to go to iTunes. There's, and I will come through and answer a few questions that are lagging behind there. iTunes, you can always listen to our Tax Tuesdays, plus all the other podcasts that we put together. Everything on qualified opportunity zones, cost segregation, how to set rents, residential assisted living. I'm looking at just a few. They're all on there. You can do that either through iTunes or Google Play. Replays are in your Platinum portal. We always make a few of the replays available to y'all. I believe this is the last Tax Tuesday of the year. We're going to take a break during the holiday week, so this will be the last one for the year. You can always go in and watch more videos on our YouTube and Facebook. Have a lot of fun there. And if you have questions, shoot them into Tax Tuesday at AndersonAdvisors.com or visit AndersonAdvisors.com. And there's plenty of ways to contact us there. Does the replay go on iTunes too? Yep. So we take them and we make them into audio files so you can listen to them while you are in the car. That's what I do. I'm a podcast freak, so I like to listen to the podcast rather than the radio. Radio tends to be depressing these days. What did Jeff say? You get a tax credit for paying taxes in a non-resident state?
Yes, I did.
Yes. So the answer is yes. Here's one.
Well, and that's assuming that you're in a state with taxes, living in a state with taxes.
Yep. So can you pay directly the personal mortgage from an LLC or an LLC tax as an S-Corp? Yes, you can absolutely do that. And I've done that many, many times. And back in my more wily days, I've actually bought houses with the mortgage without telling the lender, because there was like a 2% loan on an expensive house. And I just put it in a land trust and took over the loan. So yeah, you're not supposed to do that, but that's always fun. What else did we have? We have a whole bunch. Last session before, which I submitted, just not answered yet. Robert, we're gonna have to pull that in. You're gonna have to send it in via Tax Tuesday. So here's the deal, guys, and I see all the happy wishes and all that fun, and I really appreciate you guys. I'm just gonna say this: that sometimes we get over 400 questions a session, and I am going through them, and sometimes they're coming in so fast, and I'm answering other questions that I just can't keep up with it. If I did not get to your question, and I know there's probably a couple, send them in to Tax Tuesday at Anderson Advisors. We will make sure we're getting you an answer. So I just have to do that. Do you have any podcasts on land trust? Absolutely. In fact, if you want to go more coffee, I know I'm trying. I'm on one screen today. Usually if I have 3 or 4, I can zip around. Here's what you can do is if you're looking for specific answers on certain questions, or you want to learn about something like a land trust, go onto our YouTube channel. There's a ton on there. And then as we're going through the some of my staff are sitting there and answering your questions off to the side too. You'll see that there's an answer to some of your questions. The question is the land trust pretty simple, or is it just as lengthy as a living trust? Very simple, Kevin. Very simple. We keep it super simple. And do you provide audit protection services? Yes, on all the returns that we prepare, we provide audit protection services too. And what is this? I sent it to Tax Tuesday before Thanksgiving. So Robert, I'll take a look at that. We will get it back. If you send it in, we should be answering it. So I know it's going to be in there. We will find it, Robert, and we'll make sure we get you an answer. So I appreciate you doing that. To the doctors, when are you having another seminar in Honolulu? Oh boy. I'm over here in Maui right now, and I've been here twice in the last month and a half. So I know we're going to be coming back over. We have Xavier, and we have Lane Kawioka over there. We have a bunch of really cool groups. We need to get over to Honolulu and do another one. Is that where you're at, Mark? I hope so. It's beautiful over here. So granted, the time distance is weird. I was actually watching football games at 8 in the morning, which is kind of a trip. You guys are used to it when you're over here. And that is it. So I'm just going to say thank you guys. This is the last one. Clients of both Paul and Lane, you are a rock star then. Both are really great guys. And yeah, we want to come over there. We always come over and meet with Paul, and whenever Lane invites us over, absolutely, maybe a tax court. So, you know what, Joe, you're absolutely right. I think we ought to do a tax-wise in Hawaii. It would be much more fun, except I don't think anybody would stay in the class the full day. Merry Christmas to everybody. Jeff, do you have anything else you want to throw in there?
Nope. I just want to wish everybody Merry Christmas, and we will see you next year.
Absolutely. Thanks again, guys.